welcome back to OnlyTax, where we give you the naked truth about how the tax system really works. No fluff, no confusion, just real mistakes and real solutions. Today, as you can see, firstly, of course, I have a new gear in me. So, hey, what's up? Today, okay, let's get into it. We're talking about one of the most powerful tax strategies in real estate, cost segregation. Let's jump right into today's segment. Our segment is what is cost segregation? So, Jason, let's start with the basics, all right? A lot of real estate investors hear the term cost segregation, but they're not always sure what it actually means. Can you explain it?
Sure, no problem. So, cost segregation is taking things like items that are normally depreciated over 5, 7, or even 15 years and taking all of that depreciation in year one. So, for example, right, electrical panels, flooring, roof, those are things that's normally depreciated over multiple years, but with cost segregation and using that with bonus depreciation we are able to take all that depreciation in year one, which should be very powerful, especially if a client qualifies for real estate professional status, because then we could take that massive loss and have the client lower the taxable income by using that passive loss to offset their either W-2 income or any other business income that they might have.
That's great. Then why is this such a big deal for investors?
Yes, so that's a big deal for investors, Ring, because first of all, prior to last year, when President Trump had passed the One Big Beautiful Bill Act, the bonus depreciation was slowly winding down. For example, in 2022, it was 100%, and then in 2023, it went down to 80%, and then in 2024, it went down to 60%, and then in 2025, it was supposed to go down to only 40%, but thanks to the One Big Beautiful Bill Act, they pushed it back to 100% bonus depreciation. So to answer your question, Ryan, why is that so important? It's because real estate investors are able to take a bigger deduction in the current year instead of them having to capitalize or spread that depreciation over multiple years, which could result into big tax benefits for the client.
That's great then. Okay, lastly, can you give us a quick example of how this works in real life?
Yeah, so great question. So we have a client who purchased a property last year in 2025. They bought it for $400,000, right? Let's just make the math simple. They bought the property for $400,000. And let's just say it was in Georgia, okay? They bought about $45,000 in capital improvements to the property. Normally, that would have to be depreciated over 39 years for the actual property since it's a short-term rental. And then for the capital improvements, some of them would have been depreciated over 5 years, over 7 years, over 15 years. And then so the client would have had to take that depreciation in bite-sized pieces over multiple years. But what we did for the client is that we did a cost segregation, and then we're going to use the 100% bonus depreciation. And then the client submitted a logbook, which showed that they spent over 100 hours on their short-term rental in 2025 in managing the property and fixing things on the property so that that allows them to take that passive losses and offset their active income. So what does that mean in real life? So let's say the client makes about $250,000 from their W-2 job, and then let's say that this bonus depreciation is able to give them, let's just say, $100,000 of additional deduction, so they are able to offset their $250,000 of active income with $100,000 of passive losses. Because normally, Rain, if you make over $150,000, passive losses could only offset passive income. By the client qualifying for the short-term rental, loophole, they're able to offset the active income with the passive losses, which will lower the taxable income significantly. So just doing quick math, right? And I want our video editor to put the math here, right? So let's say that the client bought the property for, let's say, $420,000, right? And then let's say they had $45,000 of capital improvement. So that's $465,000, right, Wayne?
Mhm.
And then let's say that we remove the land because, as you guys know, land is not depreciated because the IRS assumes that land lives forever. So that's why land is not depreciated. So that gives us about an estimated depreciable basis of $348,000. Then let's be conservative, right? Let's say that
Mhm.
only 40% of that is eligible for bonus depreciation, right? Because how bonus depreciation works, Rain, is that you can only do bonus depreciation for things that have a useful life for less than 20 years. So then therefore the actual property itself, you cannot do bonus depreciation on that. So let's see how much of this is eligible for bonus depreciation. So let's do 40% just to be conservative. So that's $348,000 times 40% equals $139,000 is eligible for bonus depreciation. And then remember that since the client bought that property after January 19, 2025, that entire amount is eligible for 100% bonus depreciation rate. And then now if you multiply that amount by 24%, which is, let's say that's their tax rate, that gives a client an estimated tax savings of $33,000, right? So can you imagine that, right? By us doing something as simple as a cost segregation, we're able to save the client about $33,000 estimated in tax savings. So that is the power of cost segregation.
Yeah, it is a powerful thing. That's right. So lastly, is when should someone actually think about doing a cost segregation?
Yes, so I would say that if you are thinking about buying a property, a rental property, reach out to your CPA or your tax professional and see if it makes sense for you to do a cost segregation. Because based on from what I've seen, cost segregation analysis costs around $2,000 to $4,000 for a single family house. And that's just a cost segregation, right? That's not the actual tax planning piece. And what I wanted to say is that you don't want to be investing $2,000 to $4,000 for a cost segregation if it does not benefit you. For example, if you make over $150,000 and then let's say you don't qualify as a real estate professional, then all those losses won't be able to offset your active income. And then all that will just be suspended. So that would be a waste of your investment. So talk to your tax professional. I know that was like drinking out of a fire hose ring. We just gave the audience a lot of information in a few minutes. So a lot of people are probably saying, what the heck is he talking about? That's a whole bunch of numbers. I'm super confused. I need to rewind this video. I need to watch this again. But sit down with your CPA, sit down with a tax professional, and they'll actually explain it to you using your own personal numbers and their personal income amount so that it will make more sense to you. Okay. And if you guys want us to look at your situation personally, and if you want us to analyze your situation to see if our cost segregation would make sense for you personally, please reach out to our team, send an email to Rain, and then tell her to schedule a call with us. We'd be happy to help you with that.
Yeah, we can definitely help you with that. Just reach out to us. And yeah, I know this is a lot of information, but I believe that you do need to be knowledgeable in this case regarding this one. And yeah, that's a breakdown of cost segregation, one of the most powerful tax strategies available to real estate investors. So if you own investment property or you're planning to buy one soon, this might be something worth discussing with your tax advisor or with us, you know? Again, thanks for watching Only Tax. If you have any articles, any questions, or even memes and even like TikTok videos that you or reels that you want us to react to, send it our way and we'll definitely check it out. And thanks for watching Only Tax, where we give you the naked truth about how the tax system really works.